Welcome to De-Risk Investing. Today, we're dissecting a titan of the digital world, Roblox. This is a platform that lives in the imagination of millions, a pioneer of the metaverse. But on Wall Street, the story is more complex. The stock has fallen more than 30% from its recent peak, hit with analyst downgrades, and now facing lawsuits from multiple states over child safety. The big question for investors is stark. Is this pullback a generational buy-in opportunity in a long-term growth compounder? Or is Roblox a classic value trap where a captivating story has become dangerously detached from financial reality?
Sarah, the disconnect is staggering. Let's cut right to the chase. The stock is currently trading around $88. Our quantitative model, based purely on discounted free cash flow, pegs its fair value at just under $22. That's not a small gap, that's a chasm. The market is pricing Roblox on a narrative of flawless, perpetual growth. It's paying for the dream. Our model, on the other hand, is anchored in reality. It's heavily penalizing the lack of current profitability and the simple fact that growth, so far, has not translated into shareholder value.
That's a sobering start. Let's place this in the broader context. The macro environment is shifting. We're seeing forecasts for U.S. GDP growth to slow significantly in the fourth quarter. This implies that the discretionary spending that fuels platforms like Roblox could be at risk. And within the gaming industry itself, the landscape is evolving. The trend is towards user-generated content and AI, which should be a tailwind for Roblox's model. However, this also means the field is getting more crowded. The most immediate headwind, though, is legal. These lawsuits from Texas and Florida aren't just noise. The implication is a future of higher compliance costs, increased scrutiny, and potential damage to a brand built on being a safe space for kids.
Exactly. And those headwinds are hitting a business that is already struggling financially under the hood. Let's talk about the engine and the fuel. The engine, revenue growth, is impressive. The top line is growing consistently. But that's where the good news stops. The company shows no signs of operating leverage. Operating expenses, particularly R&D, have exploded, growing right alongside revenue. They are spending every dollar of gross profit, and then some, just to keep the machine running. Now for the fuel, or the balance sheet, and frankly, it's concerning. Free cash flow is improving, which is a positive sign of life, but the capital structure is a mess. Using a metaphor, this balance sheet isn't just carrying an anchor, it's dragging a ball and chain. Total debt to equity is over 450%. For an unprofitable tech company, that is a massive risk. They're funding operations by taking on debt and by diluting existing shareholders. The share count has climbed from under 600 million to over 700 million in just a few years. That's the ultimate red flag, a negative return on equity, meaning the business is actively destroying shareholder value.
So the internal fundamentals are shaky at best. This brings up the crucial quality check. How does Roblox stack up against its peers? A stock can be a bargain if its issues are temporary, but it can also be cheap for a reason. Is Roblox trading at a discount because it's a misunderstood opportunity, or is it because it's simply a lower quality asset than established, profitable players like Electronic Arts or Take-Two? And more importantly, what is the chart, the ultimate arbiter of supply and demand, telling us right now?
The evidence is damning when you put it side by side with competitors. Roblox has a negative PE ratio. Profitable peers like EA and Take-Two trade at multiples in the 20s and 30s. Investors are paying nearly 14 times sales for Roblox, which is double what they pay for EA, a company that actually generates a profit. Roblox's operating margin is negative 22%. It's being valued like a best-in-class growth story, but it has the financial profile of a struggling startup. Now, let's apply the cluster rule to the technicals. First, the trend cluster. The trend is unequivocally broken. The price has sliced through every major moving average, the 50-day, the VWAP, and has fallen out of the bottom of the Ichimoku cloud. This isn't a dip, it's a waterfall. Second, the momentum cluster. Indicators like the MACD and the Awesome Oscillator are not just negative, they're accelerating to the downside. The selling is gaining speed. Finally, the volume cluster. On-balance volume and Chaikin money flow confirm the story. The charts show a clear exodus. This isn't retail panic, this is big money voting with its feet and heading for the exits.
And this is where the plot thickens, creating a fascinating paradox for investors. The fundamentals are weak, and as you just laid out, the chart is completely broken. Yet, if you look at Wall Street sentiment, nearly 2/3 of analysts covering the stock rate it a buy or strong buy. The options market is also leaning bullish, with a put-to-call ratio below 1. So, Alex, this brings us to the rhetorical pivot. Who is right? The analysts selling the long-term metaverse story, or the price and volume data showing what institutional money is actually doing with its capital right now?
That's the key conflict. The sentiment data reveals the battlefield psychology. In the options market, you see a massive pile of call options stacked at the $100 strike price. That's the bull's dream, a big, round, psychological number they desperately want to reclaim. It represents hope. On the other side of the field, the heaviest concentration of puts, of insurance policies, is way down at the $60 strike. That tells you where smart money sees the floor if this breakdown accelerates. It's a vote of no confidence in the current price. And what's really telling is the short interest. It's low, under 3%. This isn't a crowded trade for the bears, which means there's very little fuel for a potential short squeeze to drive the price higher.
So let's bring this all together for our final verdict. Roblox is a classic story stock that is now battling a broken chart. The bull thesis relies almost entirely on faith in the long-term monetization of its massive user base, and faith that the metaverse narrative will reignite and justify today's valuation. But hope is not an investment strategy. The bear thesis, in contrast, is grounded in today's reality: persistent negative earnings, significant shareholder dilution, and extreme valuation relative to profitable peers, and a technical picture that is screaming danger. The new legal and regulatory overhang only adds another layer of unpriced risk. For us, the risk-reward is clearly skewed to the downside. Our final rating is a sell.
And here is how we would structure that from an execution standpoint. For anyone defending a long position, the invalidation level is clear. A sustained weekly close back above $105 would be the first signal that the sellers have lost control. That's the line in the sand. But the path of least resistance is down. The primary downside target is the $60 level. That zone represents the launch pad for the entire 2025 rally, and it's also where we see that heavy put interest concentrated. A break of 60 would mean a full round trip, erasing a year's worth of gains, and would signal a much deeper, more painful unwind is likely.
That's all for this week's Deep Dive. Thank you for your time, and remember that this podcast is for informational purposes only and not financial advice. All investment decisions should be made with the help of a qualified professional.